Welcome to another video in the series Learnings from the Newspaper. In this video, I have selected the article with the title Here are 7 pieces of investment advice from the Oracle of Omaha. This article was published in the Economic Times on 3rd October 2017. So this article is mainly related to the investment advice given by the Oracle of Omaha, or in other words, Warren Buffett. He is known as Oracle of Omaha because Omaha is the place where he resides, and he is very famous for his advice and wisdom. So let us look at the article. So this gentleman here is Mr. Warren Buffett. I have personally read many books written on his advice for investing, and this article kind of summarizes all the learnings given by Mr. Warren Buffett in a very nice way. So let us look at these advices. Imagine if you could sit and have a cup of coffee with one of the world's richest men. What if that rich man built his wealth the same way you are building yours, through investing? What if the man were Warren Buffett? So Warren Buffett is a billionaire investor and has been in the top 10 world's richest men for a very long time. So the article goes on to say, what would you ask? Would you try to learn something that would completely change your entire world of financial success? Perhaps you feel like that would never happen. How could I ever sit and learn from Warren Buffett? The truth is that you can. No, maybe not in the traditional sense of an actual face-to-face coffee brunch, but you could get some insight from what he has to offer by looking at the things he has already said to other people. In fact, there are 7 insights he has already shared from which we can glean a lot of understanding about wise investing. So let us look at these 7 learnings from the Oracle of Omaha. So the first advice is, risk comes from not knowing what you are doing. People talk about how risky the stock market is. So in terms of investment, Warren Buffett mastered the investment in stock markets, and his primary strategy was value investing, which is picking up stocks which have very high potential in them, however are not priced at the right value. So people talk about how risky the stock market is. It's just too easy to lose money, they say. Sure, it's got risks involved, but so does depending on one employer who could go bankrupt or let you go at any time. So here basically he's saying that the general perception that people have is that stock market is very risky. And he says that it is definitely risky, but he says that everything in life has risk. If you are working for an employer, that employer could go bankrupt or all of a sudden could lay you off from the job. So how do you manage risk in the stock market? So Buffett suggests to know what you're doing. Learn. The more you understand it, the better you will be at it. So one of Warren Buffett's main teachings is that you invest in something that you understand. So in Warren Buffett's history, he never invested in technology companies. He used to say, I don't understand technology. And still, he is one of the richest persons in the world. So he invested in whatever he understood, and he knew that it would grow. So that's what he's saying, that know what you are doing, try to understand more, and the more you understand, the better you will get at it. And don't be afraid of taking risk. Now let's move on to the second learning. Someone is sitting in the shade today because someone planted a tree a long time ago. So he says that if you plant a tree today, it will take time to grow, and only when it has grown to a size where it can provide you shade will you be able to sit and relax under it. What a beautiful advice. So he says the best time to invest is several years ago. The second best time to invest is now. The sooner you get in, the better. Don't wait to buy stocks. Buy stocks and wait. So he's saying that people generally have the tendency that they wait for the right time. Let the stock come down to this level and then I will buy. Let the stock come to that level and then I'll buy. But he's saying that in that wait, you should not miss the opportunity to buy that stock. So if you think the stock is good, invest now. And the sooner you start your investment, the better it is. Because it takes time for stocks to give you beautiful returns, and you need to have the patience to keep them that long. The third advice is, should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. So what he's saying is that let's say you have a boat and it starts leaking from one place. You fix that, and then it starts leaking from another place. You fix that also, and then it starts leaking from the third place and continues leaking from one or the other place, and you keep on fixing it. So instead of devoting your energy in fixing that chronically leaking boat, change the vessel and move on to another boat which does not have that leaking problem. So here Buffett is talking about the sunk cost fallacy. This is the idea that you have already put money into something, so you should keep striving to make money with the initial investment, even if doing so is both risky and requires more time and money. If you got into a bad deal, it's better to count your loss and move on than to try to force your way into making something from nothing by dropping more resources into a lost cause. So a lot of times what happens is, let's say you bought a stock at $100. Now it starts going down. So it goes to 90 because of some bad results that it announced. Then again you think that no, it is a good company, it will go up. Again it goes up to 95. Then again next 2-3 quarters it again gives bad results. Again it goes down to 85. And then again you start thinking that, okay, should I invest more because it is at a lower price. You invest more in it at 85, thinking that it will go up, it's a good company. And it further goes down to 75. And then you again invest or again put your money in that stock. Actually what is happening is, you are thinking that it is going down even though it has a lot of potential or it has a lot of value. But actually it does not. It is a leaking boat. So it has its fundamentals which are badly distorted. So it will continue to go down. So you have to identify that it is a leaking boat and take the loss. Even at 75, you realize that, okay, it is a leaking boat, it will continue to go down. Take a loss at that time and invest in a growing stock at the same price. So invest that $75 and move it into another stock. Maybe in a year, that stock at 75 will go to 100. Whereas the older stock at 75 could go down to 50. So that is what Buffett is advising in this point. The fourth advice is a public opinion poll is no substitute for thought. Rather than jump on the latest headline with the newest fad, it's better to think things through for yourself. Use your head and make wise choices based on your own analysis, not someone else's. So, again, Warren Buffett is saying that think yourself, learn about the stock market, and analyze yourself. Don't go by what somebody else is talking about or the latest fad. A lot of times, people in the stock market get some tips. Some colleague or some stockbroker gives a tip. And they say that, okay, this stock is going to make me a lot of money, maybe 10 times in a year, and they invest heavily. And finally, what they get out is maybe that investment has become zero. Now, the person who gave the advice will simply say, oh, I'm sorry. But who suffers at the end is you. Your money is gone. So, Warren Buffett is saying that think through it yourself and then make the right choice. The next advice is the only time to buy these is on a day with no why in it. Very interesting advice. So he says there are some stocks that are simply never good options. It doesn't matter what the newspaper says. It doesn't matter that your friend has stock in that company. There are some deals that just are not worth having, so avoid them. So basically this advice is that these stocks, this word day has Y in it. So buy it on a day with no Y. That means you don't buy it on any day. So he's saying is there are some deals which you should never get into. Keep a note of them and do not invest because some of your friend or somebody gives you a tip to buy that stock. The sixth advice is it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So let's say you have two companies, company A and company B. Now company A has a stock which is currently trading at $15,000, whereas company B has a stock which is trading at $15. You think that company A is a great company, but its stock has already given very good returns and it is already at a fair price. Whereas company B is doing okay, but the price is very, very undervalued. So which of these two companies should you invest in? So Warren Buffett's advice is it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. So this is a fair company, this is a wonderful company. The price of this stock is fair, but the price of this stock is undervalued. So he's saying that invest in company A because this 15,000 slowly, probably in a year, may become $20,000. Whereas this company B, which is doing okay, the stock at 15 may come down to, let's say, $12. So even though the growth here is very steady and not very rapid or not very fast, you buy this stock because it has more guarantee that it will grow. Whereas company B could have grown from 15 to, let's say, 30 in a year, giving you 100% returns, but it could also go down fairly easily and fairly quickly. So invest in a company at a fair price than a fair company at a wonderful price. So the article says the wisdom here is that the focus should be more on the company itself than on the price of the stock. Not to say price is irrelevant, but Buffett is emphasizing that a good price on a stock of a bad company is still a bad idea. What you want to look for is a good company and then buy it when the stock is priced well. Coming to the seventh advice, I always knew I was going to be rich. I don't think I ever doubted it for a minute. So this is the confidence that Mr. Warren Buffett always had. And he's saying that you also should have this confidence. So these words are some of the wisest we can consider when it comes to investing. Buffett is dealing with mindset. You have got to know you are going to win. It may not be today. It may not happen the way you think it should. But deep down inside, you've got to know you will win. That will make all the difference. So he's saying have confidence and that's when you will win. So these are some of the very good advices given by Mr. Warren Buffett. I would say these are timeless advices which were applicable yesterday, these are applicable today, and will be applicable even tomorrow. I hope you liked the article and the video. Let us know your thoughts. Thanks.